Well, the markets are in a positive mood this morning. Increasingly, there have been signs the U.S. interest rate hiking cycle could be over, which was seen as a positive. But maybe based on the latest GDP numbers, it will also come without tanking the economy. This idea of a Goldilocks scenario getting some buzz on Wall Street. Lauren Goodwin is an economist and portfolio strategist with New York Life Investments, so the perfect person to talk with about these subjects. Lauren, it's great to see you. Thanks for joining us.
Oh, fantastic to see you, John. Thanks for having me.
I mean, getting this narrative right, is that why investors are feeling bullish as we come to the end of November here?
Absolutely. I believe the Fed rally is here, Fed relief rally. This is a moment where upward pressure on interest rates for the U.S. environment, which has been such a point of uncertainty for investors, is starting to lift. And as a result, I expect that we might see a month or two of positive risk performance across risk assets. The challenge, though, for investors is that this moment in time, this Fed relief rally, is likely only a step on the way to investors realizing that the slowdown in inflation and growth that we're seeing is likely a step on the way to recession. And so I do believe the relief rally is temporary, but that investors should take advantage in the moment that we have.
Now, I'm glad you brought that up because, you know, we live next to the elephant that is the United States. I think the state of the Canadian economy is such that a lot of people see a sooner contraction, if you will. And then to your point, you know, history tells us that at the end of rate hike cycles, you can see a reasonably positive stretch for stocks. But if you're in a recession in that period, performance can differ. How are we going to know what the economic picture is ultimately going to look like? Are we only going to be able to do that in the rearview mirror, or is there anything you're going to be watching very closely in these next few weeks?
I think that we're going to have some clear signs in the next few weeks that tell us which direction we're headed. When the Fed or any central bank starts raising interest rates, the economy tends to evolve in a very similar way, even in an extraordinary cycle like this one. First, you see interest rate sensitive and liquidity sensitive sectors like housing start to experience some stress. I think it's one of the reasons why we're likely to see the Canadian economy slow quicker than the United States. Then you see manufacturing and services sectors slow. That's when profit margins start to squeeze. And that's where we are right now. The next steps that we'd expect to see are the consumer and the labor market. So it doesn't surprise me that we've had relative resilience in these sectors so far. The things that will show us that we're headed into recession, frankly, already in recession, are when unemployment claims rise and earnings start to turn negative. Now, we are not there yet. That's why I expect we have several weeks before we have to really be concerned about our risk-off stance in the markets. But those are the things I'm watching most closely to know that it's time to pull back on risk exposure.
Well, let's dive into that commentary. I mean, you alluded to it a little bit, but for portfolio positioning, what is paramount right now?
While we're experiencing this upward push in risk assets, I expect that investors that can be very tactical can take advantage of lifts in equities, especially the small cap and value equities that have been beaten down when risk wasn't so in favor. I also expect that credit assets will continue to see an upward lift. Now, as we're seeing that move forward in risk assets over the next few weeks, we are taking advantage in our portfolios to start to rebalance towards those themes which we expect might be more resilient as the economy does continue to slow, frankly, globally. So that's in many cases, large cap equities. In tech, we're looking actually across the market cap spectrum, looking mostly at profitability to build some resilience in that sector where we see some enthusiasm. We're also looking at infrastructure equity, which we believe has some defensive properties. Now, in credit, though, or fixed income, this is an area where we expect in the U.S. specifically, the cycle's likely to look a bit different. All the support for corporates, publicly traded corporates over the last couple of years points to potentially the high yield asset class performing better than in past economic cycles. So we're taking some equity like risk there.